Hi everyone. Welcome back to Positioned.app. Today we're continuing part 2 with our previous topic of the Relative Strength Index, or RSI. As with any technical indicator, RSI has limitations: false signals during strong trends, delayed reactions in highly volatile markets, variable effectiveness across different asset classes, subjectivity and interpretation. Let's examine these 4 major pitfalls that both academic research and practical experience have identified. As we can see in this chart, RSI provides valuable insights, but it's not infallible. At point 1, RSI moves above 70, signaling overbought conditions. Yet, price keeps climbing, showing a false reversal signal common in strong uptrends where momentum persists longer than expected. At point 2, RSI drops below 30, hinting at a buy opportunity. However, price continues falling, illustrating how oversold readings can persist during strong downtrends. Don't catch a falling knife. At point 3, RSI lags behind a sharp price drop. Since RSI averages price changes over time, it reacts with delay, often causing traders to enter or exit too late. In fast markets, relying on RSI alone is like chasing a bus that's already left. Combine RSI with trend analysis, price action, or divergent signals to improve timing and reduce false moves. It's crucial to understand that RSI's effectiveness varies substantially across different asset classes. For instance, equities often respond differently to RSI signals than commodities. Forex markets may require different RSI threshold settings than crypto markets, or, even within equities, growth stocks and value stocks can exhibit different RSI characteristics. This variability means that standard RSI settings, 14-period with 70/30th thresholds, may need calibration for specific assets. This chart shows how standard RSI settings perform differently across 4 major asset classes. Tech stocks, standard RSI settings, 14-period 70/30ths, tend to work well with traditional stocks, showing high signal accuracy, 76%. Commodities, gold. The same settings yield much lower accuracy, 42%, for commodities, where price movements follow different patterns. Forex pairs. The visual illustrates how standard RSI settings perform poorly for currency pairs, but optimized settings, 9-period 80/20ths, yield much better results. Cryptocurrencies. Shows how standard RSI generates too many signals in volatile crypto markets, while modified settings, 21-period 75/25ths, better filter market noise. The visual clearly demonstrates why traders need to calibrate their RSI settings based on the specific asset class they're trading. The most significant limitation of RSI perhaps is the subjective nature of its interpretation. 2 experienced analysts can look at identical RSI readings and draw completely different conclusions. In this chart, both analysts are looking at identical data. Analyst 1 interprets the RSI as a bearish signal and sees an overbought signal and anticipates a potential downturn, deciding to sell or stay out. Analyst 2 sees a bullish opportunity in the same data and sees rising momentum from the midpoint, viewing it as the start of a bullish trend and a chance to buy. Why the difference? It comes down to personal factors. Time frame. One analyst might be looking at daily charts while another focuses on 4-hour intervals, completely changing their perspective. Risk tolerance. A conservative trader might want to avoid any hint of overbought conditions, while an aggressive trader may be willing to ride momentum higher. Multiple indicators. These analysts are likely using multiple indicators beyond RSI. One might see confirmation from MACD or moving averages, while the other sees contradictions. Experience. Personal experience with specific market conditions heavily influences how traders interpret technical signals. The key takeaway: RSI should never be used in isolation. Combine it with trend, volume, support/resistance, and market context for balanced, data-driven decisions. By strategically combining RSI with complementary indicators, traders can develop a more comprehensive analytical framework that filters noise, confirms signals, and offers deeper insight into underlying market conditions. This multidimensional approach not only enhances trading decisions, but also adapts to various market environments where a single indicator might falter. For example, moving averages with RSI. Combining RSI with moving averages allows traders to confirm whether the momentum indicated by RSI aligns with the broader trend direction. When RSI signals oversold conditions while price remains above key moving averages, this creates a stronger bullish signal than RSI alone, particularly in trending markets. Volume indicators with RSI. Volume validation strengthens RSI signals by ensuring price movements are supported by appropriate trading activity. An RSI reversal from oversold territory accompanied by increasing volume provides greater confidence that the momentum shift is legitimate and likely to continue, while low-volume RSI signals may represent false moves. Other oscillators with RSI. Using MACD or stochastic oscillators alongside RSI creates opportunities to identify convergence or divergence between different momentum measurements. When multiple oscillators show alignment, all indicating overbought or oversold conditions simultaneously. The signal strength increases significantly, while divergence between oscillators can warn of potential trend exhaustion. Support and resistance levels with RSI. Integrating price-based support/resistance levels with RSI readings creates powerful confluence zones for trade entries and exits. RSI reversals that occur precisely at key price levels historically respected by the market substantially increase the probability of successful trades, as multiple forms of market analysis align at the same decision point. When trading, RSI is valuable but requires skill to use effectively. Review your recent trades to see if you're interpreting RSI correctly. Consider combining it with other indicators for more comprehensive analysis. Your analysis will improve with practice and patience. Share your insights in the comments. In our next video, we'll analyze the recent chart of Tesla's stock in action using the RSI and the 50-day simple moving average, SMA, for a better understanding. If you found this helpful, like and subscribe for more trading education content. Also sign up for Positioned.app for real-time swing trading signals. Let's make smart trading decisions together. Thank you for watching. Until next time, happy trading!